presentation contains current opinions of Moez Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compac YouTube update for May the 27th, 2025. I'm Mo Ansari, President of Compac Asset Management, and I'm going to talk about the markets, what happened last week, what to expect this holiday shortened week. First of all, I want to wish all of our veterans, all of the people that make all of the sacrifices, happy Memorial Day. I hope and we got to salute all of them because all the sacrifices they make, they don't do it for the money. And all the families that don't see their dads and their moms and their kids and so on for months and years on end at times, thank you for your service. Let's start with the market numbers. First of all, don't forget to subscribe to this channel. Just go to compac.com/YouTube or click on the subscribe button right now. So whenever I post an update, you will be notified. Looking at the numbers, last week the market, we had the terrible tariffs back. On Friday, the president said that he's going to impose a 50% tariff on the European Union. Market went down big on Friday, but over the weekend he said, wait a minute, I'm going to not put those tariffs on until July the 9th. So the extension of the tariffs brought the market back up. It's up nearly 2% today alone, but last week the market, the S&P, was down 2.58%. We saw the same thing with the Dow, down 2.43%. NASDAQ down 2.45%. The big positive was IFA. Those are the European markets. The inflation numbers came out last week, and they were a little bit lower than expected, and that sets the stage for the European Central Bank to cut interest rates, and that is why the European markets have done well. Consumer staples were the best performing sector last week. Worst was energy, down 4.1%, and that was because of the big, beautiful bill, as it's called, the tax bill that was passed by the House. It does cut quite a bit of the energy subsidies, and that caused the energy market to come down. But as I said 2 weeks ago, before I went on vacation, the big focus is going to shift from tariffs to taxes. And that's what we're seeing now. The bill is going to be now debated in the Senate, which I think will pass. And the bill overall, when you look at it, it was a little bit better than expected. Interest rates, last Treasury yields were at 4.51% on Friday. They came down after the bill passed. So the bond market has given the stamp of approval to the new bill. What is in the new bill? Well, we've got a lot of cuts, which is positive. When you look at the cuts, all of these are tax spending cuts. These are tax cuts, which are about $3.5 trillion. That's the extension of the 2017 tax cuts. Then there's cuts in spending in the energy, and then there is cuts in taxes. For salt cap comes down, tax on tips, no tax on tips, manufacturing incentives, some cuts for Social Security beneficiaries, and other tax cuts. All of that increases the deficit. That's why it's in red. And then you look at the Homeland Security and defense spending goes up. That's obviously spending going up. So spending comes down. Domestically, the biggest one is the cut in Medicaid. How big is that going to be? How many people are going to be affected by it? It's large and it's been pulled forward, but we'll have to see how the hawks in the Senate want to cut spending more. But the $2.3 trillion deficit expansion is less than what the market was expecting. It was expected to be around $3 trillion with all the tax cuts and not enough spending cuts. But we saw some big spending cuts, which is a big deal. For the first time, we're seeing government being reduced, the amount of spending by the government being reduced significantly. And that is always good. And that is why I think the market is reacting positively today. We get service and manufacturing PMI improved last week. This week we do have durable goods, initial claims for unemployment, personal income, spending, and then Chicago PMI. So we don't have a lot of significant data this week. Looking at the technicals, we came down, kissed the 200-day moving average. This is Friday's market. Came and tested it right here. and then we popped right up today. We gapped up, and now we start the fifth wave. The next target becomes somewhere right around 6,100, which is the highest, all-time highs that we made in the market. So have we completed the fourth wave? We'll have to wait and see. Are we starting a fifth wave rally, or this is just a pullback within the third wave and we continue to move higher? We'll have to wait and see. I think we have completed 4 and we're starting in 5, which should take us above this high and test this. But I don't expect a runaway bull market. There's a lot of uncertainty still there. The tariffs are still there. Again, they're on, they're off. That's creating uncertainty in the market. We're looking at the tax bill, what eventually is approved by the Senate and the House committee when they get together and put that bill in front of the president, what is going to be exactly the final bill, and then how much do the tariffs, which I think will be higher than where we started in the year, how much higher, how much lower are they going to be from where they are now, how much slowdown that causes in the market, how much does that bring the inflation number down? All of that is still uncertain, and that is going to continue to keep a cap on the market. So I think we go back and forth, not a runaway bull market, unless we see a resolution of all these issues and we get the tax bill passed, we get the tariffs settled. Then it gives the Fed some time to look at how to reduce quantitative tightening a little bit more, QT, and then eventually tax cuts, interest rate cuts later on this year, depending on how much slowing we're getting because of the tariffs. So all of that could be positive, but all of that could turn negative too, depending on how and where we end up. So that is going to put a cap, I believe, on the market. Sideways to slightly higher is going to be the bias going into the end of summer or through summer. That's the way I'm looking at it. Technically, on the weekly chart, we came and tested again the 20-week moving average right there, bounce up from there. Now the target again from the third wave. This is a weekly chart going back nearly 3 years. So each one vertical line, green and red line that you see is 1 week of trading, not 1 day of trading like the previous chart. So the target becomes somewhere around here, but that could take until next year to get there. Daily chart on the NASDAQ, again completed wave 3, should see wave 5 starting. Again, test of the 20,000 number would be somewhere that we could see wave 3, but we're already at 19.2 today. So not a lot of upside, but we could get 800 points on the upside more before we come. But again, summer, back and forth, more fundamental news. Weekly charts turn positive. The dot plot is here, down here now. Market is way above it, so I think we're headed higher, but it could take weeks for us. Interest rates peaked out last Thursday, came back down. We were at 4.6, now we're at 4.43, down about 20 basis points. So the market gave it sort of the bond market gave the big, beautiful tax bill a sort of approval, and that's positive for the market. Gold down big today, down about $65 an ounce, testing 20-day moving average, 250 days right here at 32.10. Anything pull back right there, but I think the bulk of the gains for the gold market are behind us. Now, oil sitting at about $61 a barrel. I think if we get some kind of resolution, which seems there's something going on between between Ukraine and Russia, if we do see some resolution coming out of it, that could be positive. Those are my thoughts. Those are my observations. I will be back with you next week. Don't forget to subscribe. Click on the subscribe channel to subscribe to this channel, so whenever I do an update, you'll be notified. If you need help with your portfolio, go to invest@compact.com, send us an email, or just give us a call at 800-388-9700. I'm Mo Ansari. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.